A company's market cap is one of the best ways to determine whether a company is overpriced or undervalued. Stick around to find out why. How's it going, guys? Ryan here with another episode of my Stock Market Basics series, and today we're talking about why it's better to look at a market cap when valuing a stock as opposed to the share price itself. But before we get into that, please remember to like my video. It helps me out so much, guys, and remember to subscribe for more content. And with that, let's get into it. So first and foremost, what is market cap? Well, market cap stands for market capitalisation, and effectively it is what the share market values a stock to be. And the way you determine it is the number of stocks on issue multiplied by the current share price, and that will give you an overall market cap value. For example, if you take the value of a stock which is $5 per share and they've got 1 million shares currently on issue to the market, you times those two numbers together and you'll get $5 million. And effectively that is what the stock market is valuing this company to be at this current point in time. Now, you can have various sizes of market cap. You can have a small cap, a mid cap, or a large cap. You may have heard of all these three before. Now, when you're looking at small caps, you're tending to look at under $1 billion. When you're looking at the mid caps, it's about 1 billion to 10 billion, and a large cap is considered to be anything in excess of $10 billion. And when you hear the terms effectively penny stocks or blue chip stocks, they tend to fall into one of these few categories. So if you're looking at penny stocks, they'll always tend to fall in the small cap range. But when you're looking at the blue chips, they'll be in the mid cap to large cap area. Now, taking the market cap at its face value isn't going to be that beneficial. What you want to do is have a greater understanding of the company itself and the environment it currently exists in. This will give you a good indication of whether the stock market is valuing this company at a correct or reasonable price, or whether it has been oversold, so it's a significantly lower value than it actually should be, or whether it's overvalued and it's a lot higher price than it actually should be. And these sort of factors can help you to determine whether or not you should buy this stock and whether it's likely to continue to increase or continue to decrease in its current position. The common misconception people actually make is that the share price dictates the value of the stock, and this is incorrect. It is the market cap that values the stock. So for instance, you could have a $1 share, but this is actually worth more than a company with a $5 share price. And this all comes down to the number of shares on issue multiplied by the current share price. So for example, if we take two stocks that I've just randomly made numbers up for, the first stock, for instance, has 1 million shares on issue and it is $5 per share. And this is the example we discussed before. This would be valued at $5 million. Now, if we take a different company and it is 100 million shares on issue, but the stock price is $1 per share. Yes, the share price is lower. It will be $1 per share, but the market cap is $100 million, which means this company is actually worth more at the $1 price point than the other stock, which is existing at the $5 price point, which is worth $5 million. This is why you shouldn't be looking at the share price to value a stock. You cannot compare the value of the first stock to the value of the second stock solely off the share price. You need to be looking at the market cap itself to actually understand the intrinsic value of the stock that the current market has given it. It's all well and good to understand this concept, but how can you actually use it to your advantage? And now one of the best ways to do this is to enter into a market where you understand the environment. So you've done a bit of research on it. You know sort of what different stocks are worth and why they're worth different prices. And then what you can do is effectively look at the market cap of a company and determine whether or not it is undervalued or it has been overbought and is at an inflated price point. And in doing so, effectively what you can do is buy stocks at a lower price, which should naturally rise if you pick those ones which appear to be undervalued. If we put this in perspective, we can take that fictional $5 million market cap stock again. And basically what we would do is then research that stock. And let's say we did our research and we saw that they had $5 million cash on hand and $5 million assets. And they have no debt, assuming that effectively brings the company's value up to $10 million with the cash and assets combined, whereas the market cap's only $5 million. Effectively, what we've done then is understood that this company is actually worth double the current value the stock market is giving it. So if this was the $5 share that we were looking at before, it's actually in fact worth $10. Now this is a significant increase, and depending on the leverage, obviously if you've only got 1 million shares on issue, you don't have much, but if you bought this stock, in theory, it should re-rate at some point to that $10 million price point without any other sort of factors being taken into consideration. But when we take that into the real world, we can see this occur in various different scenarios. So if we've seen a stock take a plunge due to a poor announcement, for instance, it might drop, for instance, 50% in value, which is an extremely large amount. And this may have been caused by stop losses being triggered or a lot of various other reasons, but we might be able to actually analyze that stock and say, hey, this has been oversold and the stock's worth a lot more than the current market value. And therefore we can realistically buy this stock in the hopes of it increasing in value and have a relative bit of confidence that it will increase in value due to the fact that we understand that this company is intrinsically worth more compared to what the market is currently valuing it at. Understanding the difference between the current market cap and the relative value of the stock itself is one of the first things I do in order to determine whether or not I should be putting my hard-earned cash into this stock. And it can effectively set you up for success in the sense of you could take 10 stocks which you're interested in investing in, and it'll allow you to filter probably quite a few of them out. If they're significantly overvalued, you just want to steer clear of them. They might have just gone up on hype, whereas you can then cut that down to look at the more stable stocks which you think are going to grow in value over the next long or short term. And with that, guys, I'm wrapping up today's video. I hope you enjoyed it. If you did, please remember to leave a like down below and leave any comments, questions or queries about market cap and how to use it when you're evaluating a stock. And with that, guys, I hope you have an awesome day. See you next time.